Today's announcement, I think, was big, and I mean really big. And even though the base rate only went up to 5.25, so a quarter of a percentage point, everybody was expecting that. But what people were not expecting was the language that came from the bank. And I read somewhere this week that the bank were being advised not to give any forward-looking statements as to what's happening. Today, they gave a statement that was about as strong as they've given so far, that we are not out of this yet. And for me, that signals what could be a turning point in this fight against inflation, what's going on with interest rates long term, and how that feeds into the property market. So what I'm going to do today is I'm going to crunch some numbers. I'm going to mathematically prove to you how, if we are now in a fundamental shift in the interest rate environment for a longer period of time, how this can have a quite significant impact and downward pressure on property prices, real property prices. Let's talk about real rather than nominal, over the next 5, 10, 15, 20 years, maybe the next cycle, okay, maybe the next generation. And I don't say this lightly. There's some interesting data we're going to crunch through. There's some interesting concepts I want to cover today, or at least start to cover today, because we're going to have to talk about these over the next few weeks. But in the meantime, a very good evening to you. Welcome. If you can see me and hear me, please give me a thumbs up. If you can write something into the comments box to let me know you're here and you are engaged, that's fantastic. As always, if you are new to the channel on these lives, please put your questions in. I'll always try and come and answer them. If you're watching on the replay, again, put your questions in. I will always come and answer those. And if you've not seen any of these live streams before, my aim for this is to go through objective data, to cut through the media, cut through the headlines, cut through the BS, cut through the hyperbole, and see what's actually going on so we can make better decisions, primarily as property investors. Okay, but actually this is probably going to be of interest to anybody who has an interest in the property market as a whole. So looks like we've got some thumbs up, which means you can hear me and see me. So that's fantastic. Right, I'm going to try and be briefer today as well. I have a habit of going on a little bit too much. So I'm going to be succinct. This is what we're going to cover. We're going to cover 5 main things. We're going to cover interest rates, the interest rate announcement today, and what actually went on in that. I want to look at an outlook. That US is USA, not us. An outlook of where we might go, okay? And actually, I want to be honest with you. I put this slide deck together yesterday. So I already had some ideas of where I thought this was going. And today just totally reinforced what I was going to talk about tonight. I'm going to talk about the nationwide HPI, house price index, which came out a couple of days ago. So we'll see what's actually going on with house prices according to Nationwide. I want to talk about savings outflow. So this is UK personal savings. Now, last week, I talked about the surprising resilience of savings and how savings ratios are not being affected too much at the moment, which is surprising given cost of living, increased interest rates, all that sort of stuff. But we found some good data. I found some good data that we're going to use to talk about that and why we are in that position right now and how that might change. But most importantly, and I want to tease you a little bit here, possible futures of what's going to happen in the medium term with the property market. I think we're getting to the stage, I'm just going to come off this. I think we're getting to the stage now that I want to stop talking, about all these little short-term blips, okay, or short-term events. So today, everyone's like, oh, it's amazing. We're only up 0.25%. We're at 5.25%. It was only a few months ago we were saying that it's not going to go above 4%, right? It was probably 2 months ago I heard people saying if we get to 5.5% on mortgages, then everything starts melting down. We're way beyond that. And markets and a lot of people are very short-term in their thinking. So they see data and they go, boom, reactive, short-term. So last week, CPI was better than anticipated, or the week before, I can't remember when it was. Everyone started high-fiving, going, this is awesome, we're out of it. Interest rates are going to peak at 5.75 rather than 6.25. It's still 5.75, right? And whether it's 5.5, 5.75, 6.25, it doesn't really matter in the short term, okay? The damage is already being done to people, to businesses, to people who are borrowers. Of course, it's good for savers. The damage is already being done above 5%. The question now we need to ask is what's going to go on in the medium to long term, because this is going to have total fundamental ramifications as to how we invest in the property market for the next cycle. So that's what I want to have a look at today. Okay. What are your thoughts on it, by the way? I saw Shane put at the beginning of this, must have put it on yesterday, his bet was on 0.5% interest rate rise. Sorry, it looks like you've lost that money to your wife, Shane, 0.25%. But Out of the 9 MPC members, 2 did vote for a 0.5%, 6 voted for 0.25, and only 1 voted for a pause. Okay, so that's quite interesting. Seems to me like, if you look one dovish, 2.5 0.5% rises. The feeling is still we've got longer to go here. Okay, feeling is still we've got longer to go. So that's a nice graph of what the interest rate rises look like. We're at 5.25%, highest in 13, 14 years, whatever it is. Yeah, look, it doesn't really matter too much anymore what I say. These little 0.5, 0.25%, we're above 5. We're high. We are high, and more people are coming off their fixed rate mortgages every single day, every single week. But this is what they said. This was what the bank said afterwards. Interest rates to stay higher for longer. Okay. You cannot get much more of a market narrative direction for the bank than that, I would suggest. So for me, that's a strong signal saying, look, all of this euphoria over the CPI print, let's not get carried away here. We're not out of this yet. When we looked at the CPI data, primarily it was brought down by cost of fuel. Okay, so transport was a big thing that came down. Cost of fuel, petrol, diesel has, over the last 12 months, dropped significantly. But that is still a volatile commodity. And I said when it came out, there's no reason why this can't go back up, why cost of fuel can't go back up. And you look at the predictions, the cost of Brent crude, it is predicted to rise over the next 6 to 12 months. Okay, that's the cost of fuel. The other big thing, well, the other 2 big things are utilities. We know that's come down, but we know, because I've covered this quite a lot, that we're still forward buying at 2-3 times the spot price right now. Okay, so this autumn, this winter, into next spring, we're still going to be pretty much where we were last year in terms of cost. And the other one is food. Food continues to rise at an incredible rate. Yes, it dropped a little bit in terms of its actual net. So it went from 18 or 19 to 17, but it's still going up a lot. And in fact, I'm going to show you in a sec. No, I'm going to show you now. Right, I'm going to go to this. So literally, this week's news, supermarkets warn over food prices as Putin blockades grain exports. Now, this is obviously sort of a developing story that we got, where the sort of Black Sea grain treaty or grain corridor, where, effectively the ships can come out, go to Ukraine, pick up the grain, come out and distribute it around the world. Russia's withdrawn from that. They're now effectively blockading. This is not good news, okay? Russia are now striking the port, Ukraine's Danube port, sending global grain prices higher. Grain prices going higher is going to feed into the supply chain, okay? It's going to feed into those inflation figures. I don't know how long it's going to take. I don't know how much. I don't know if it's short term or if it's going to be a longer term issue. This is not going to suddenly go away. I've seen sort of experts now talking about potential extra spike over the winter in fuel costs again, okay? So I don't feel we're out of this yet, because that core inflation that we looked at in the last session is still high, and sort of owner-occupier housing costs is still rising. So that's quite a big indicator of where the bank thinks we are. So what's your thoughts, by the way? Let's see. Jackson, the wife. PSR, I read today the interest rates are likely to be above 5% in approximately 2 years. Do you see this being the case? Yeah, this is the point. I think this is an absolute turning point. If people are now starting to get their head around, we're not just going to spike up and spike down on the interest rates. Okay, I felt for some time they're going to be higher for longer, but the question is, and this is the fundamental question, how long? I'll get to that in a sec. I want to answer that question in a minute. I'm not going to give you an answer to how long they'll stay on for, up for, by the way. Nobody knows that. It's going to depend on so many factors. The bank don't know that. The Bank of England will be looking at the data every month and deciding what to do. So it's all going to be driven by the data. Nobody knows what's going to happen. But we need to mitigate. We need to understand what the possibilities are. So outlook, and this is the slide deck I put together yesterday, right? This is inflation over the pond in the USA. They are down at about 3% now, okay? They've really got this under control. They're down about 3%, and a lot of that is actually their sort of living costs, their cost of rent, their cost of housing, living, which has got a big lag in the system. So effectively, when you strip that out, they're well under control. However, they've just put their interest rates up again, okay? And they said, this is literally yesterday or the day before, Fed Reserve to signal it's not done yet on interest rate rises. Everybody, central bank-wise, is pretty nervous about second wave inflation coming in. And so rather than, hey, look, inflation's coming down, let's just start easing off the interest rates or bringing them down, I think for everybody around the world, right, they're going to be up there longer. And before I heard the bank's narrative today, I was going to say they're going to be up for longer. The question is how long. Any thoughts, by the way? What do you guys think, guys and girls, on the live stream? any predictions? I'd love to see some predictions. I could see bank rates being above 5% for 2 years. I could see it. I could also see a case for them coming down, by the way. But I don't think they're going to come down much below 4 for an extremely long time. I think they're going to settle 3.5, 4, and we're going to be in a new normal. And I'm going to tell you what that's going to do for us. Shane, I went in to look at buying new Ford Ranger for my company, quoted me 11% interest rate. Yeah. Shane, it's an interesting. I just got quoted for a business loan to buy some extra 7.5 tonners for the scaffold business, 19% interest rate through Funding Circle, plus a $3,000 arrangement fee on a 40 grand loan. I declined it. Funny old thing. Okay, let's come back to interest rates in a sec. I want to talk about nationwide HPI that came out because it's easy to lose track of the data that's coming out in actual house prices. These aren't actual, this is nationwide, with the sort of CPI, interest rate, all that sort of stuff. So what's actually going on in the housing market? We had a small drop. So we had a 0.2% drop in July. This is on the nationwide housing price index, which is based on their mortgage approvals. Okay, so again, if those mortgages fall out of bed, nobody knows that they're still in this data, but 0.2%, which takes our annual change to minus 3.8%. And I know a lot of people are still saying, look, it's still only minus 3.8%. This is the fastest rate of descent now on an annual basis since the 2008 crisis. But as I said last week, the big thing that we care about here is those inflation-adjusted house prices. That's the real value of the houses coming down. Okay, and that's coming down quite quickly because we're in a falling property market in a high inflationary environment. High inflation, strong wage growth, house prices falling, right? Actually, real-time house prices coming down quite a lot, and that's important. Now, this for me was fascinating. Again, this is taken from the nationwide HPI, bank rate path implied by financial markets. So you can see how it varies quite a lot. But in the next 36 months, we've got a little bulge, right? Coming basically, when's that sort of peaking out in about 6 to 8 months from now, based on the data on 27th of July, which was last week's data, peaking out. So what's that, sort of end of this year peak is when they reckon. And then it's coming down, but we've got 36 months ahead, still estimated right now to be above 4% in 36 months. So it's 3 years. 3 years from now, the prediction is it's still going to be above 4%. And of course, there could be additional shocks. It could go down. You can see on 15th of May, it's much lower before that sort of sticky inflation came in. So that's what the markets are pricing in. I do feel this is still very dependent on external shocks into the system. Escalation in Ukraine, food prices going up, grain going up, supply, energy shocks, any other third party, black swan event could bring it up. But let's just say 3 years from now, we're still going to be above 4%. This is nationwide data. This is looking at, this is quarterly, so I could only get back to 1970s by looking at the quarterly data here in terms of annual percentage change in UK house prices. Now you can see here, right, we are dipping below zero, and in the last, what's that, 40, 45, 50, the last 50 years, we've only dipped below zero on 3 occasions, and this is the 3rd occasion that we've had annual falls looking at this quarterly graph. Now, I do want to relate what's going on now to 2008, okay, which was that V, versus the 90s, which was a much longer and shallower correction. And when you look at the circumstances, we're definitely more akin to the correction of the 90s, which was, very much driven by high interest rates, high unemployment, right, and going into recession. But we're more similar to that than we are 2008, which was the credit crunch. So I'm not expecting us to V down, right, from here. I don't expect us to V down. I expect it to be longer and shallower. And I've said since I started this channel that I'm expecting a long and shallow correction rather than a big crash. And nothing that I've seen today or over the last week or so in the figures has led me to change my belief on that. Okay. That's the nationwide HPI. What's your thoughts on that? Anybody surprised that it's kind of being resilient? Anybody thinking, yep, actually, it's coming down quite steadily? Now we're going to see what's happened. What we got? Let's answer some questions. Luke, would a recession cause a drop in rates? So effectively, Luke, what they do is they're trying to push us into recession, right? By getting the rates up, it pushes us into recession. Let's go really simple economics. rates go up, pushes us into recession because people, they don't want people to buy as much stuff. So when the interest rate is higher, people are going to be more incentivized to spend than borrow. To save than spend. Let's get that the right way around. Save to spend, right, and borrow. So if they want to cool an economy down, they don't want people to carry on buying stuff. So if they want people to save rather than buy, put the interest rates up, they get more. Interest rates going up is actually going to make it more difficult for business. People buy less, businesses make less, jobs go away, unemployment goes up, takes us into recession, right? And what they want to do is they kind of want to do a short, sharp hit to get rid of this inflation, which economically is, as a theory, is fine, assuming that inflation is caused by an overheated economy. But we are not really in an overheated economy, right? There was I read an article today that we're not in this sort of greed inflation, which I'm not sure I agree with that. It's something that came out from the bank. There's no evidence of greed inflation, but there's something that it's a new term that I've heard called pass the parcel inflation, which is the only reason that prices are going up and therefore wages, kind of going up as well, because in that sort of wage price spiral, is because everything's become so expensive, utilities, food, energy, fuel, all that sort of stuff. Businesses have to put their rates up in order to pass on those costs to everybody else. So it's like you've got increased costs, therefore you've got to put your profit up in line with that to keep your margin. And there was a report that came out today that I read. I'm going to analyze it more and do a different video on it, where they said there's no evidence of greed inflation. Actually, and this was to the end of 22, most businesses' profit margins are remaining the same. I find that difficult to believe when you look at how much the utility companies are making, for example, and the water companies and all that sort of stuff. But let's strip the energy companies out of it and let's just look at most businesses. The argument is going that actually most businesses' margins are staying the same right now because there's this pass the parcel inflation. So which means that the inflation is not caused by an overheated economy, it's caused by third-party influences that are the raising costs of production, all that sort of stuff. So I'm not sure if that answers your question at all there. What do you see happening in the London housing market? Still not seeing any significant movement on asking prices. I've got to be honest, I'm not going to comment on individual markets because I'm not exactly sure. I'm not in different markets like that. I see some people on social media talking about big price reductions in London, so I'm not sure where you look, where that is. There's always going to be micro economies, micro climates, micro changes. I wouldn't like to comment without seeing the data on that. Okay, let's go on to. By the way, give me a thumbs up if that's sort of a useful look at the nationwide and if we are kind of tracking as we expect, or is there anything going on that's unexpected? Right, I want to look at savings outflow, and after the savings outflow, I'm going to go into the big thing I want to talk about, which is where are we going in the property market? Big picture, not microclimate. So savings outflow. Last week, I talked about, let's put this up. I talked about how during COVID, our savings spiked up. Everybody was given a lot of money, saved a lot of money for sitting around at home, not doing anything and not spending anything for quite a significant part of 2020 and into 21. So as a nation, we became quite liquid. This is evidenced by the graphs of savings inflow into accounts. However, we're now seeing this savings outflow. And again, I showed a graph last time, if you want to go back and look at the last live, that shows the big sort of spike down of savings outflow of bank accounts. But what surprised me was this graph that I went through, which is the household saving ratio is pretty resilient right now. And actually, if you look at it here, it's at a higher level here than it is pre-COVID. So we've got a saving ratio of about 5%, then we spike up in COVID, and then it's kind of settled, and we are at this does go into 2023. About sort of 8%, so it's still higher. Now, that very much surprised me, and it didn't just surprise me, it surprised a lot of economists and analysts as well. So I was reading a report by the Resolution Foundation, right, which talks about the effects of higher interest rates. And one of the things it showed actually was the saving ratio that the OBR Office of Budget Responsibility forecast, which was this dotted line down here, if I can zoom in on that. Effectively, the forecasts were that everybody's going to run out of money. And they're going to run out of money sort of, at the end of 22. When I say run out of money, they're not able to save any more money. But of course, if you're not saving and your costs go up, you're going to start, negative outflow. But what's happened is it's actually stayed higher. So people are still able to save. Now, Why is this happening? There's three reasons or three explanations that this report gave. The first is the stronger than anticipated wage growth, which we know is strong. And it's probably, I think the wage growth is the thing that's surprising a lot of people. So a lot of wages are going up with inflation. But when we look at this data, right, and this is really important, when we look at the data, we're looking at averages. We're looking at averages across the country, right, rather than looking at different sort of demographics or different percentiles of the population. So it's very difficult to get an idea of what's going on for everybody when you look at an average, because by definition, you're probably going to have a disproportionate few at the top end skewing those figures. If we look at this, we can actually see that this first graph on the left is pandemic. This is sort of your net balance sheet of UK households by, they call it quintile, so every 20% in terms of sort of wealth. And you can see that pretty much everybody, other than the bottom quintile, was increasing their balance sheet, basically getting wealthier through that pandemic from 2020 to 2021. Now, when we look at what's going on, actually, okay, everybody other than the top quintile is in negative territory. Okay, so everybody is getting poorer, i.e. their wealth is decreasing or having an outflow of assets, wealth, etc., etc., apart from these guys up here. And I'd imagine when you look at the ratio of sort of taxpayers and higher earners and taxpayers and all that sort of stuff, I would have thought there's probably a disproportionate skew to this top quintile, the top 20% of our wealthy in this country. So when you average it all out, that is almost inevitably going to be skewing those figures. So the bottom 80% of the country is actually having a net outflow of wealth. It could be cash, could be savings, could be pension pots, all of that sort of stuff. Okay, so I thought that was interesting. So when you look at actual numbers of people, okay, that is a better indication of what's going on with most people rather than an average, which is quite easily skewed. Another thing that the report sort of estimated was there's a lower than expected tax drag right now. And actually, the OBR's forecast, the amount of tax they'd have collected this financial year so far, is significantly more than what they've actually collected. Now, I'm not sure why this would be the case when we had the income tax ban freeze this April. So everybody with the wage growth going up is going into higher rate or basic higher rate much more quickly because they've all been frozen. So this is something I want to investigate a little bit more over the last week, is work out why there's that lower than expected tax drag. Is it because actually a lot of the employment figures are made up and it's people on 0 hours contracts or self-employed who aren't actually earning anything? And again, we're seeing a skew. But here's oh dear, sorry, I didn't mean to do that. That's not what it should be doing. One of the big ones is, funny old thing, we are getting more income on savings. No, don't want equations. I'm trying to get my pen back. Sorry about that. More income on savings. And actually this should be fairly obvious that as the interest rates go up, there's going to be a lag with people who hold debt, because there's a lot of fixed rate debt out there. And the latest that I saw is that even now, as of today, I think 56% of people on fixed rate mortgages have expired since the interest rate started to go up, which means there's still over 40% of people are still on their 2% and sub 2% fixed rate mortgages. So the lag in this system with people coming off fixed rate debt and then having to absorb these extra costs takes a lot longer than savings, which are more instantaneously affected by interest rate rises. And when we look at this, we can see effectively the blue line at the top is disposable income, the red line is consumption, and therefore the grey area on this graph is saving rates. If I zoom in here, you can see again the OBR reckon there's going to be a cross-off point here where we go into negative, right? But we're still above it. So there's still a net savings rate that's going on with sort of UK as a country, and that is illustrated much more elegantly here on this, where we can see when we're in red, higher interest payments on debt. When we're on green, which is where we are now, higher interest rate on savings. So there's a net increase in people earning from savings than people paying in debt on their mortgages and other debt right now, if that makes sense. So as sort of UK PLC, if you like, we've got a net savings increase right now, but this is getting smaller and smaller every day as more people come off their cheap fixed rate debt, right? This is going to cross over at some point, and it's not far away from crossing over. So at that point, the savings is going to start outflowing again. This is why, right, there is so much lag in the system and why that housing market is being surprisingly resilient at the moment. There's so many factors going on at play here. And one of those big ones, I talk about it every week, is that gap, which is getting bigger every day. Interest rates are continuing to go up. More people are continuing to come off their fixed rate mortgages, and therefore the pain is felt by more. I've always said max pain is probably going to be end of this year, beginning of next year into 2024. Okay, right. I'll come back to the questions in a little bit because I want to just get on to the final section before we hand over to questions. Okay, so final section, and you're going to love this. If you love your stats, if you love your models, this is something that is going to I'm going to almost tease you today, okay, and go through sort of a broad brush concept here, but then I'm going to do a much more detailed breakdown video of this. And this is very much about what interest rates are going to be doing in the medium to long term and how this affects our housing market, which is so important. If anybody out there is looking to invest in property, we need to understand what's going to be going on in the medium to long term. It's going to drive our investment decisions and how we go about acquiring property, right? Because I believe that we could be seeing a fundamental change in how we grow wealth in this country. Not just the country, how the world grows its wealth. So you're going to love this graph. Okay. We have effectively been in a asset boom, rising asset bubble for the last 40 odd years, which is about the amount of time that I've been on this planet. Okay. Now, what this graph is saying, right, that if we look at this yellow line here, right, this would be, sorry, I'll start with the blue line is total net household wealth as a percentage of GDP. Okay. Total UK net household wealth as a percentage of GDP. You can see it's been a pretty much overall macro line up, right? We've been getting wealthier. We've been getting wealthier as individuals. Now, if we were to strip out passive gains, so passive gains is owning an asset that then goes up in value, okay? If we were to strip out passive gains, that's this second line down the bottom, the orange line, which you can see is much shallower. And effectively, this report that I've been looking into, which is extensive, it's about 60 odd pages long, makes the argument that the majority of wealth created in the last 40 years is entirely down to the macro trend of decreasing interest rates. And I've actually got a graph that shows global interest rates over the last 40 years, and it's pretty much a straight declining line when you sort of average it out. So the majority of our wealth has been caused by increasing asset prices, okay? And so this is not active, making money and saving it. It's just buying a house and the house goes up in value. Now, I want to zoom in, okay, to where we are now. Based on, and so this report is a little bit old now, or the data is a little bit old, right? You can see the estimate for Q1 2023, which we're out of, is here. So up and down, right? If I sort of finish that off, you can see that graph here. It's estimated that in the last 18 months, since the quantitative tightening, if you like, the interest rates going up, we've wiped off about 20% of the UK's personal wealth. The majority of that right now is actually, just to explain that, as interest rates go up, asset prices generally come down. It's almost like interest rates, almost like gravity to asset prices. And the main asset prices that have been affected at the moment are pensions, specifically defined benefit pensions, right? Because they have been squeezed as the interest rates go up. Property, not so much so far, because we have started to come down, but we're not in sort of full-on crash meltdown yet. Anyway, that's where we are right now. Let's go to the next slide. The next slide is a more accurate model, and this is a fascinating model, to value houses, right, based on whether they are overvalued or undervalued. And up to now, I've been putting on the graphs of house prices to income, so that affordability ratio. And that's pretty much what everybody talks about, is this affordability ratio, which is purely income to house prices. So what multiple of your income are house prices? And it's been going up and up and up, right? We understand that. It's been coming. It's coming down a little bit now because we are in a correction. However, it's not the most accurate model to define whether house prices are overvalued or undervalued, because of course there's so many other factors that go into it. We might have much more disposable income, for example, or things might be tighter like they are now. Anyway, this model aims to more accurately value houses based on, it's called a user cost model, which is basically the cost to somebody of owning a house. And I don't want to go into the model itself because it's about 10 pages of mathematical formulae to come up with this. But it claims to be one of the most accurate ways of identifying whether property is overvalued or undervalued. And this goes back to 1987. You can see there's been 3 peaks, 1, 2, and here we are right now. Okay, so 2023, we are not far off. So what's that, 65, 66%? We're not far off where we were in terms of overvalue of the peak of the last 2 markets. Not quite as much, right? But it's not started coming down yet because all of our other costs that go into our income have to be accounted for. So when you look at house prices to house price to income ratio, it's starting to come down. When you look at house price to the cost user cost model, we're still going up right now. Okay. Now this is interesting. This is going to have a bearing. However, this is the one we need to really understand because this is how house prices will go based on 2 scenarios. Again, this is all from this Resolution Foundation report. Scenario 1 is actually scenario 2 in the report, is that interest rates come back down. So we peak and we come back down to sort of pre-pandemic interest rates, sort of sub 1% or, 0.5%, whatever. And this is looking at house prices as effectively a ratio of annual whole economy total pay. Okay, so this is effectively our earnings to house price ratio. It's saying that if interest rates fall back to that sort of pre-pandemic, it's expected that house prices go up to about 11 times earnings. However, it paints a picture for a new normal scenario, which is interest rates coming up and staying up for a longer period of time. And I'm going to go into what criteria they use for this in a second. But in a new normal scenario, in a higher interest rate environment, they are estimating that house prices will settle just below 6-time average earning ratio to house prices. So that's a huge, huge gap, huge difference, right? And one of the things they take, or one of the models they use for this particular graph is taken from this report, or staff working paper number 837, which is a Bank of England report written in December 2019, titled UK House Prices and 3 Decades of Decline in the Risk-Free Real Interest Rate. Sounds very interesting. I'm not going to go deeply into this report because it's pages and pages like this. So unless you're an advanced statistician and analysis, all you really care about is the summary, right? To go to the summary, I want to read you this. Today, global yields, by the way, this is 2019. So this is before COVID. This is before we started our tightening cycle. Today, global yields and inflation-proof government bonds are at a historical low. In the UK, the 10-year index-linked gilt yield in early 2019 was a little under -2%. So index-linked is basically real interest rates. So real return. So it's inflation-adjusted, a little under -2%. Were the 35-year trend to reverse and gilt yields to rise rather than fall, the research indicates that there would be a very substantial long-term consequence for real house prices. Again, real house prices, inflation-adjusted house prices. Our results suggest that a 1% change in real interest rates that was persistent could move real house prices by just under 20% across many years. So there's a lot of figures there, and there's some vagaries in there as well. So what it's saying, one of the vagaries is we don't know what persistent is. So the 1% change that was persistent, I don't know. Sorry, I keep touching the wrong thing. I don't know if persistent is 1 year, 5 years, 10 years, right? And prices to adjust by under 20% across many years. I don't know what many years is. That again, is that 3? Is that 5? Is 10? But let's just focus on this. For every 1% change in real interest rates, it suggests that real house prices come down by 20%. Now, for the life of God, I could not find a chart of the 10-year index-linked gilt yield, but I did find a 30-year index-linked gilt yield chart. And you can see that we've gone on the 30-year, right, from, let me just go drawing again, right, down here in sort of, what's that, Jan 22, we're at -2.5%. And right now we are at 1%. So that's a 3.5% difference, 3.5% increase on the 30-year index-linked gilt yield. Now the 10, I think, is not quite as much as that. But look, if we use this and we go, right now, interest rates are at 5.25. Inflation is at 7, right? So if we go really super simple on this, 5.25 minus 7, real interest rates are still minus, what's that, minus 1.5, okay? Minus 1.5. If that inflation starts coming down, interest rates stay high, it's not going to be long until interest rates are above inflation, right? And then we see that very real change in real interest rate. And it's going to be significantly more than 1%. But the question is, how long does it last for? How long does this interest rate environment last for? If we are now in a new norm, if we're now in a high interest rate environment, we are going to see a significant decrease. I say that with certainty. This is a report, it's a model. We all know that models have inaccuracies, but we're going to see a reduction in real term house prices. If we look, again, this is the end of Q2 2023, inflation adjusted house prices according to the nationwide HPI, we are already 14% down, right? We can see that we have already got a significant decline in real house prices. We are in a position where we're still in a high inflationary environment, but house prices are still dropping, which means real term house prices are coming down. So this is the question I want to pose to everybody. What is going to happen long term? Are we going to go back to cheap interest and cheap debt and assets continue to go up? And by the way, with assets going up is not necessarily a good thing. Assets going up, it might sound good if you've got a portfolio, but with assets going up, it means yields reduce. Over the last 5-6 years, as property investors, we've had to be hunting for more yields. If prices going up, yields reduce. You only cash in when you liquidate that asset, which could be when you retire, you sell it to somebody else. If asset prices come down, yields go up, which if you're a cash flow investor is actually a brilliant thing. You're going to get a lot more for your money and you get a higher return for your money. This for me is good, right? Because it means we can save more, we can reinvest more, and we can build more rather than those asset prices going sky high. So property going up infinitely is not a good thing. It also obviously creates that wealth divide more, whereas if the affordability ratio comes down, more people can get on the ladder. It's actually good for everybody in society. So there we go. That's my analysis for today, team. There's lots of people on. Hello for everybody who's new or not been on before. Put your thoughts on that piece of research. I'm interested to hear your thoughts on that piece of research, that model, if you think it's a load of baloney, or you think there's merit to it. I feel there's some real merit to it. And so I'm going to be deeper diving into this report. I'm going to be creating a longer form video of what the ramifications are and how this should be changing our investing decisions. Because, the days of just, it could, I want to say it could, there's always a quantum of probabilities. Here, low interest rates. Here, high interest rates for a long time. And high does not mean we're going to stay at 5.25 or 5.5. But if we settle at 3.5 and 4, right? If we settle at 3.5% and inflation goes back to its target of 2, we're 1.5% above inflation, right? Real interest rates are 1.5%. They've been sitting at about minus 2%. That's 3.5% difference, right? Use that model. You're looking at 60% drop in real-term house price. I don't think that's going to happen. But all of a sudden, the claims of this sort of longer-term large correction in real-term house prices, which will sort of filter in at some point to nominal as well if the economy carries on struggling, which it's forecast to, if unemployment goes up, which it's forecast to, right? And if wage growth slows, which is forecast to, that will start to filter through at nominal house prices. But it's not going to happen immediately. It's going to happen over the next 6, 12, 18 months. Let me know your thoughts on it, team. Let me know your thoughts. Luke, all good. I would love to see how a deep recession could change the course of action and rates. Covered the questions though. Maybe what we just talked about, Luke, answers that a little bit. What's your thoughts? Give me a thumbs up if you think interest rates are going, thumbs up, is that a good thing? If you think interest rates are going to stay high for long, give me a thumbs up. If you think interest rates, if we're going to peak and then come back down quickly, by the way, the contra-argument to this is that we tighten too much. Interest rates continue going up, breaks the whole system. We go into a deep recession, and then to get out of a deep recession, we have to, inflation undershoots, right? So that target is 2%, it undershoots, could even go negative, could go deflationary. And then we have to ratchet the tightening away. Does that make sense? We've got to ratchet interest rates down, effectively go back to easing, right? So we don't go into deflation. That's a contra-argument to what I've just put out there. There's always both. We just have to keep an eye on what's going on, keep an eye on the data. Every month we need to look at it. I think it's interesting. Let's see if we've got any more questions. Shane said, how is it? Yeah, we're talking about high interest rates viable for business. Well, simple answer is it's not. The simple answer is the whole point of this is to make it more difficult for business to take heat out of the economy. So we're not just pumping out, supply, which everybody's hoovering up. That's kind of the point, is to make it difficult, which is, as a business owner, is great, right? It's like brilliant, another thing to not help us out with, So yeah, look, we're still using our old vans. I would rather probably take equity investment into my business right now than debt, if I'm totally honest, to do things like that. So that's something to consider. Okay, I hope that's been useful, team. I'm going to wait 10 more seconds, see if there's any more questions from anybody. If you think of anything else afterwards, please put them in the comments on the recording. Just if you will indulge me, I wrote a few weeks ago a white paper on the future of UK buy-to-let investing. Everything I've talked about today, nothing has changed in my view about what we should be doing as investors. We have to be looking for two things. We have to be looking for how to add value to get momentum, right? And especially if passive gains are going away, if passive gains are going to be a thing of the past, as investors, we have to be able to add value ourselves rather than just buy and hold and let the market take it up, right? So we've got to be smarter to do that, add value. And second is cash flow. Cash flow is key. To combat higher interest rates, we have to be investing in higher cash flowing assets. Lots of great things out there. I detail it all in this white paper. It's totally free, just a PDF. There's a link down there. There's also a link in the description of the video, and I'll probably put it in the pinned comment on the replay. So feel free to download that and indulge in 20, 30 minutes of light reading. It's not too bad. Okay, team, it's been a pleasure. Next news to look at will be the Halifax HPI. I would imagine probably coming out maybe tomorrow or beginning of next week. I can't remember. And then we're probably waiting for the ONS HPI and the latest inflation print to see where we are heading. In the meantime, I hope you're enjoying the rain. It's pretty miserable, isn't it? I think we're getting some sun next week, so hopefully we can get a bit of an Indian summer. I know my kids need to be outside and running around, but I'll leave it for tonight. As always, if you feel value in what you've just seen, please feel free to subscribe to the channel and give me a good like, and I'll see you on the next live.